Welcome to the show. Interest rates are down, housing sales are up, unemployment is up, the Dow is down. Are you confused about all the ups and downs in the economy and what it all means to you? My guest today has some answers and some predictions of what may happen here in the near future. Peter Schiff is a stockbroker and analyst and is president of the brokerage firm Euro Pacific Capital. Thanks for joining us.
Thanks for having me.
This morning. You know, there's been a lot of confusion. I think we were all happy for a while. Tech stocks were doing really well. Housing prices are up. Interest rates are down. September 11th came along, and we've had kind of nothing but bad news ever since. Is this expected? Is this what's going to happen? What's going on?
Well, I think the news is going to get a lot worse. I mean, first of all, when you said that tech stocks were doing well, the stocks were doing well, but the companies were never doing well. You know, a lot of the earnings were being manufactured. You know, a lot of the executives of the tech companies are compensated through stock options, and therefore their incentive is to do whatever they can to get the short-term price of the stock up so that they can sell their options and make money. It doesn't matter if what they're doing is sacrificing the long-term solvency of the company. They don't care about the long-term solvency because they're selling in the short run. So rising prices only benefit you if you're going to be a seller. But as a long-term investor, you've got to look at the fundamentals of the company. You've got to look at the dividend yields. You know, that's how you make your return. I mean, what a stock is, the way you value a stock, it's the present value of its future dividend streams. And most people today who are buying stocks don't even look at dividends. And most companies aren't paying them, which is one of the reasons that they can get away with faking their earnings. Because if you don't have to pay a dividend, you can pretend you're making money. Just like the reason that Enron was able to pretend they had earnings is because they didn't have to write a check. You can't send out a pro forma dividend check that says, you know, this is the money that we could have paid you out in dividends, right. You know, but don't cash it. You know, so the market is still extremely overvalued, and don't believe the propaganda, and that's what it is. When you're listening to an analyst on a lot of these popular financial shows, or the mainstream Wall Street firms, you're not getting investment advice. You're getting propaganda. These firms are trying to sell you stocks. Their real clients, their banking clients, are trying to get rid of stock. And they hire these Wall Street firms to peddle their merchandise, and they want to get as much as they can for these overvalued stocks. So you're not getting unbiased advice by the media. We are in the early stages of a bear market. This bear market is going to last for a long time. We were in a bull market from 1982 to 2000. Bear market began in 2000. It's probably going to last another 5 to 10 years. I think the bulk of the downside is going to happen in the next couple of years. Then we'll probably trade sideways for a while, but inflation will be very substantial. Just like people forget, we had a terrible bear market in the 1970s. The market peaked, the Dow Jones peaked in 1966 at 1,000. It then went down to about 600 in 1974. It didn't get back above 1,000 until 1982. So from 66 to 82, you were at 1,000. Meanwhile, inflation was tremendous during that period. So $1,000 in 1982 was not $1,000 in 1966. It wasn't until 1995 that the Dow got back to 1,000 adjusted for the CPI. And I can tell you this, the market even today is much more overvalued by any valuation metric than the market was in 1966. So you can expect a far more severe bear market. And the U.S. financially is in far worse shape as a nation. You know, back in early 1970s, we were still the world's largest creditor nation. Now we're the world's largest debtor nation. We had a large current account surplus. Now we have a large current account deficit. Back in the early 70s, I think the average American, the savings rate was still about 10%. Now it's negative. You know, so people are loaded up with debt. People are, their houses are mortgaged to the hilt. We have a huge national debt. We have an enormous current account liability. So we're going to enter this bear market financially on much shakier ground. So as I said, my prediction for the Nasdaq is it's going to fall to around 500. You know, right now, about 1,700. Got a long way to go down. The Dow Jones still above 10,000. Probably going to fall to between 2,000 and 4,000, but it might go below 2,000.
I've got to ask because, of course, you mentioned the media, and that's really where everyone gets their information. They get it from listening to the experts on the radio or the television news. They read all the magazines that they can and things like this because they're trying to keep up with it. We're hearing that, oh, we had a little recessionary period and it's gone. You're saying it hasn't even happened yet.
The recession has not started yet. The recession, you don't have a recession with consumers going deeper into debt. You pay off debt. You don't have a recession with home sales at record highs, at auto sales at record highs. That's still the boom. It's still the mania. And what's feeding it is foreign demand for U.S. financial assets, which is allowing interest rates in this country to be low and access to credit to be available. But I can tell you now, as we speak, the U.S. dollar has hit a new low for the year, and I think this last bull market in the dollar, which went from 1995 to the present, is over. And the dollar is going to start to fall. And as that fall accelerates, you're going to have significant flows out of U.S. financial assets from all around the world. And that is going to send interest rates through the roof. And when that happens, this whole consumer-driven economy, borrow and spend economy, is going to come tumbling down. And then we're going to have a real recession. And it's not going to be like a recession that people remember from the early 90s. It's going to be very, very severe. And it's going to be accompanied by dramatic increases in the price of consumer goods. So you're going to see a drop in asset prices, meaning stocks and real estate, but significant increases in the price of food, of clothing, of energy, of all these products that Americans consume, because where do these products come from? We import them. And we're importing them with these overvalued dollars. And when foreigners no longer want to send us real goods for pieces of paper, the dollar is going to lose value, and we don't have the manufacturing infrastructure that we used to have. We just can't produce these products ourselves. We have to rely on our ability to import. It's going to take a long time to tear down some of these malls and replace them with factories. You can't do it overnight, and you need capital. So we're in for a lengthy period of very bad economic times. And what I'm trying to do with my clients, and what I've been doing for the last few years, anticipating this, is to try to get people's portfolios prepared for what's going to happen.
Okay, I want to stop you right there because I do want to talk about what people can do to prepare for what you say is coming. Let's go ahead and take a break. Stay with us. Welcome back. You say that we're really living in this imaginary bubble and that soon the bubble will burst. Do you know really what it is that it's going to be or what it's going to take in order to burst that bubble?
As I said, I mean, my best guess is it's going to be the dollar going down first, which causes interest rates to rise, which will prick the bubble. It might very well be that interest rates rise on their own, and then the dollar goes down, and then the economy goes down, or a number of things could prick it. But it's a giant bubble in search of a pin, and it's going to find one. But I think the most likely pin is going to be the dollar, and I can see that now, which is why the most important thing that people can do to protect themselves is to diversify out of U.S. dollar-denominated assets, whether that's bonds, stocks, whatever you have. You don't want to be in the dollar. You want to be in other currencies. You can be in the Swiss franc. You can be in the euro. I have a lot of money in Australian dollars, New Zealand dollars. And these are great markets to invest for stocks. We've been buying stocks in Hong Kong, in Singapore, in New Zealand, Australia. And the reason we're buying stocks there, first, are valuation. I mean, I'm buying stocks at 3, 4, 5, 6 times earnings. Here, your people are paying 30 times earnings, 50 times earnings, 100 times earnings. And in many cases, you don't even know if the earnings are real. But the reason that I know these earnings are real is because the stocks that I'm buying are paying dividends, 7%, 8%, 9%, 10%. I got stocks paying more than 10% in dividends. We just get that just collecting our dividends. So the earnings are real, the balance sheets are good, and these companies are growing their earnings. And, you're in areas of the world, I mean, there's going to be a tremendous amount of growth in China. And the companies in Hong Kong or in Singapore are in very good position to benefit from that growth. And they're well-run companies. They got good balance sheets. And, their managers aren't getting rich off of stock options. They're running these companies for the benefits of the shareholders. And you can see that with the dividends. But the most important reason I'm going there is the currency. People need to be out of the U.S. dollar. During the 1970s, if you anticipated the bear market and got out of the dollar, you could have bought Swiss francs in 1972 at 23 cents. And by 1978, they were worth 70 cents. You used to get, in 1972, you got 360 yen of the dollar. I think by 78, it was down to maybe 150. So the people who got out and got into, foreign currencies or gold bullion. I mean, you could have got into gold to protect yourself. In 1972, gold was probably $120 an ounce. It went up to 800. So you could get into non-dollar assets to protect yourself from inflation and the devaluation of the dollar. And I think that this decade is going to be far worse than the 70s.